So if you're checking the charts this morning, you're probably seeing, well, what looks like a bit of a lull. Bitcoin is locked, firmly in that narrow band, consolidating between 86 and $88,000.
Right. It seems steady, almost uh, boring, especially after the volatile moves we've seen.
Exactly. But that appearance of calm is incredibly deceptive.
It really is. If you're only looking at the spot price, you miss the profound internal pressure that's building right now. Our deep dive today shows the market isn't really consolidating. It's undergoing what we're calling a structural divergence.
The great bifurcation.
Precisely. We have two massive, almost contradictory narratives playing out at the exact same time. On one side, you've got this accelerated financialization of the whole asset class.
Right, the sophisticated stuff, corporate treasury strategies, yield generation, regulated derivatives, maturation.
That's the one. But on the other side, that same consolidation is masking acute, even existential systemic risks.
And we're talking about national security probes, geopolitical attacks on the physical network layer, and these legal challenges that could just fundamentally restructure how everything operates.
It's a tectonic shift in the entire risk profile. It's no longer just about adoption rates or, what the Fed is doing with interest rates. It's about whether the underlying infrastructure can even survive these severe tests. We need to figure out which of these two pillars, risk or maturation, is winning the tug of war for capital.
Okay, let's start with the most immediate and frankly shocking component of that pillar of risk. It centers on the physical security of the network. We are talking about Operation Red Sunset.
This is an enormous national security story that just dropped in the last 48 hours. The U.S. Department of Homeland Security, DHS, has launched a full federal probe into Bitmain technologies.
And for anyone listening who might not be deep in the mining world, just remind us why Bitmain is so critical.
Well, Bitmain is essentially a near monopoly. They produce the Antminer series, which is something like 80 to 90% of the global market for Bitcoin ASIC mining hardware.
So if you're running a commercial mine, you're almost certainly using their machines.
Almost certainly. And the fact that a single non-U.S. entity controls the global supply chain for the hardware that secures the entire network, that's always been an uncomfortable truth.
But this investigation goes way beyond just trade disputes or market dominance. What exactly is DHS probing that makes this a national security threat?
They're looking at two very distinct and very severe vectors. The first is what they call the espionage vector.
Okay.
DHS is looking for hidden firmware vulnerabilities, basically backdoors in these internet-connected machines. I mean, think about it. These rigs are plugged into the power grid, constantly communicating data. If a foreign state actor, specifically the CCP, could remotely exploit these, they could siphon data on U.S. energy grid loads, operational capacity.
That's intelligence gathering on a massive scale.
It is. And that's alarming enough. But the second allegation, the grid sabotage vector, that sounds catastrophic.
It is the catastrophic scenario. I mean, it's what keeps utility operators up at night.
Imagine these massive mining operations in places like Texas,
Wow.
the ERCO grid.
Right.
These places consume gigawatts of power. If an adversary could remotely and systematically cycle these consumers on and off in a coordinated attack, they could induce what are called massive frequency instabilities in the power grid.
And what does that mean in plain English?
It means the delicate balance between power generation and consumption just breaks. The grid frequency dips or spikes too fast, and that can trip protective relays, cause cascading failures, system-wide brownouts.
Or even permanently damage infrastructure like transformers and turbines.
Exactly. It weaponizes the physical footprint of the Bitcoin network.
So what's the immediate hardware risk premium this creates for investors, especially in those publicly traded miners like Riot or Marathon?
It's immediate, and it's severe. U.S. customs officials have already started intercepting and seizing Bitmain hardware shipments for forensic analysis.
Wow.
So if this investigation confirms these vulnerabilities and the U.S. slaps on an import ban, these major miners instantly lose their primary supply line.
A capital expenditure crisis.
A huge one. And a severe supply bottleneck. That would just rapidly drive up the cost of hash rate and squeeze margins across the entire industry.
That's a profound threat to the physical layer. Let's pivot to a different kind of risk, the legal and financial layer. Specifically, the return of the Binance saga. We're calling it the zombie litigation.
Yeah, just when the industry thought Binance had put that DOJ settlement behind them, a major new civil lawsuit just emerged.
Who is bringing this suit and what's the core allegation?
The plaintiffs are over 300 victims and families affected by the October 7th attacks in Israel. They allege that Binance and his former CEO, CZ, knowingly facilitated transactions for Hamas and other foreign terrorist organizations. And they're saying this happened over a period of 6 years.
We've heard allegations of sanctions violations before. What makes this lawsuit so structurally significant? It sounds like it's attacking the very plumbing of how a centralized exchange works.
It does. The lawsuit specifically goes after Binance's use of omnibus wallets.
So explain that. An anonymous wallet is a commingled address, right?
Exactly. The exchange pools the funds of thousands of users together for efficiency. They keep an internal ledger, but on-chain, it all just looks like one big address.
And the suit is arguing that this pooling was a deliberate strategy to obscure illicit activity.
That's the allegation. That the commingling was used to obscure the origin and destination of funds, making it nearly impossible for compliance measures to track transactions tied to these terrorist organizations. Basically a way to evade sanctions enforcement.
Okay, so if a court rules against Binance on that specific architectural point, what's the ripple effect on the whole CEX industry?
This is the critical implication. If a judge agrees that omnibus wallets inherently facilitate illicit finance, exchanges could be legally forced to restructure their entire backend. They might have to move to fully segregated individual on-chain wallets for every single user.
Wow, that would be a massive change.
It would massively increase operational complexity, it would drastically balloon the network fees that exchanges pay, and it would just fundamentally change the economic model of centralized trading.
Okay, we've really established the pillar of risk, from hardware threats to exchange architecture. Let's pivot now to the counterbalance. The pillar of maturation. This is where we see sophisticated capital flowing into new, better structured vehicles. And the poster child for the last cycle, MicroStrategy, is, well, it's quickly becoming irrelevant.
That's right. For years, MSTR was the de facto high-beta Bitcoin proxy. Institutions that couldn't touch spot bought MSTR for leveraged exposure. But now, the data confirms a sharp decoupling. The MSTR premium is just dissolving.
Why is that proxy trade suddenly failing? I thought the scarcity of access was still an issue for some.
Two big reasons. First, that scarcity argument is dead. Spot ETFs, especially BlackRock's iBet, give institutions direct exposure to Bitcoin at NAV with much lower fees.
Right. Why pay the huge premium in MSTR's corporate structure when you can just buy the direct asset for cheaper?
Exactly. And the second reason is a massive institutional threat that could trigger mandatory selling.
You're talking about the looming threat of MSCI index exclusion.
Correct. MSCI, which manages these huge global stock indices, is thinking about reclassifying MSTR. If they decide MSTR is a digital asset vehicle, not a software company, it gets kicked out of key indices.
And all the passive index tracking funds would be forced to sell.
Forced to sell. Analysts estimate that forced selling could trigger a liquidity event between, well, anywhere from $2.8 to $8.8 billion. That potential overhang is forcing active managers to get out now.
So as the old guard fades, a new corporate treasury narrative is taking shape, and it seems to be focused entirely on Ethereum. We're seeing BitMine Immersion, BMNR, position itself as the MicroStrategy of Ethereum.
And what's fascinating is that BMNR is learning from MSTR's limitations. They have aggressively accumulated 3.63 million Ethereum. That's about 3% of the total circulating supply.
And their goal is even bigger.
Oh yeah, an audacious goal of acquiring 5%.
So if MicroStrategy defined the last cycle by just buying and holding an asset, what's the fundamental difference here? What makes BitMine's ETH strategy a better model for this cycle?
The critical distinction is that ETH is a productive asset. Bitcoin is non-yielding.
Right.
BMNR's ETH is immediately put to work staking. The staking rewards from their current holdings alone generate massive recurring cash flows that go straight to the company's P&L. This provides a fundamental valuation floor that MSTR, which relies only on appreciation and leverage, just can't match. It's proof that corporate treasuries are moving from passive hoarding to active, sophisticated yield generation.
And we're seeing that sophistication mirrored in the traditional financial plumbing, too, specifically in Europe. High-leverage ETPs are now landing on regulated exchanges.
Yes. Leveraged shares just launched 3x long and 3x short Bitcoin and Ethereum ETPs on the CESEX Swiss exchange. This is highly significant. It's basically importing what were previously high-risk degen strategies into the regulated banking system for European institutional clients.
And the technical implication of that regulated leverage is more volatility, right?
Precisely. Because these products have to maintain their leverage exposure daily, They introduce what are called mechanical rebalancing flows.
So when the price goes up, they have to buy more. When it goes down, they have to sell.
Exactly. And that mechanical action can easily exacerbate short-term spot volatility in both Bitcoin and Ethereum.
The search for yield is also fundamentally disrupting the stablecoin market through real-world assets, the alchemy of 5%.
This is a direct competitive assault on incumbents like Tether and USDC. Ondo Finance just made a major $25 million strategic investment into Figure Technologies YLDS.
And YLDS is a yield-bearing stablecoin. Explain how that works, because normally the issuer just keeps the yield from their treasury backing.
That's the key innovation. Traditional issuers keep the interest earned on the U.S. treasuries they hold. YLDS, by contrast, passes that RWA yield, the interest on those treasuries, directly to you, the token holder.
So if you can hold a dollar token that automatically generates 5% yield, why would you hold a non-yielding one?
Why would you? It forces the incumbents to drastically change their models to compete, and that competitive pressure clearly explains Tether's recent pivot into becoming a tech conglomerate.
Right.
Absolutely. Tether is using its massive treasury to vertically integrate their investment in Rumble, plus a commitment of up to $150 million in GPU services.
Yeah.
That's not just a diversification play.
They're building something.
They're building a decentralized AI computing infrastructure. They are moving from being a crypto bank to a major tech player, trying to build a sovereign tech stack that's resistant to the choke points of, AWS or Google.
Okay, with those huge structural forces in mind, let's quickly check the market's immediate vital signs. The consolidation range between 86 and 88,000 is still holding, but the technical picture is looking fragile.
Technically, the pressure is bearish. BTC is currently trading below its 20-period moving average, which is sitting right around 87,900. That's acting as resistance. The RSI is neutral, but bulls absolutely must hold the 84 to 8,500 support zone to prevent a deeper correction.
And to get back on track.
To invalidate the short-term bearish structure, we need to reclaim $92,000.
And this fragility seems directly linked to the institutional side. The ETF outflows are just draining liquidity.
Confirmed. The finalized ETF data shows continuous net outflows. BlackRock's IBIT alone recorded an outflow of over $149 million yesterday.
Wow.
And crucially, the aggregate outflows for November are now over $3.5 billion. This month is on track to be the worst on record for spot ETFs.
So the traditional institutional bid that drove us here is exhausted for the moment.
It seems to be. And this de-risking aligns perfectly with the recent macro signals, the Fed pivot reversal.
Right, the hawkish commentary.
Exactly. Recent comments from Fed officials have decisively dampened market hopes for a December rate cut. If the Fed keeps rates higher for longer, it substantially increases the opportunity cost of holding non-yielding assets like Bitcoin. That's directly fueling what we're seeing in the ETF flow data.
We're also seeing extreme divergence in the altcoin space. Let's start with the much-hyped launch of the XRP ETFs.
The launch on the NYSE was met with a pretty muted sell the news reaction.
So a dud.
Pretty much. Combined inflows were only around $60 to $70 million, far below what anyone expected. It just confirms that speculators front-ran the announcement and used the launch liquidity to get out.
Meanwhile, on Solana, a massive liquidity drain seems to be signaling the rapid cooling of the meme coin supercycle.
Yeah, wallets linked to the big meme coin launchpad, Pump.Fund, made a major move. They sold $436 million in USDC and transferred it to Kraken. And while the team called it treasury management, the market sees it as value extraction. It also coincides with a 53% drop in monthly revenue for the platform, so retail enthusiasm is cooling fast.
You contrast that with the quiet, deep institutional positioning happening on Avalanche.
A classic divergence. While Solana deals with retail headwinds, Avalanche is attracting serious institutional interest. A NASDAQ-listed entity, AVX1, just increased its holdings to over 13 million AVXs. And even more importantly, Coinbase Derivatives plans to launch regulated 247 AVX futures. That kind of regulatory plumbing signals that big institutions are getting positioned for long-term exposure.
And finally, let's bring it full circle back to the risk pillar. There's this controversy on Cardano that really highlights the difficulty in maintaining true decentralization.
Right. Following a recent network disruption, a chain split caused by a malformed transaction, the founder, Charles Hoskinson, controversially involved the FBI to investigate.
And the implication of that is pretty profound for the whole philosophy of these systems.
It sets a highly controversial precedent of, governance by law enforcement. It suggests that despite all the talk of decentralized governance, when a critical flaw happens at the protocol level, the ultimate resolution was to rely on a centralized physical authority, the FBI, to police an otherwise trustless on-chain system.
The code meets reality.
The unavoidable intersection of code and physical reality.
So as you can see, that tight $86,000 to $88,000 range is just a superficial marker. Beneath it, the market is being pulled apart by two colossal forces. You've got immense geopolitical and supply chain risk, coupled with significant legal fragility, but it's counterbalanced by this fundamental structural financialization yield-bearing assets and the strategic positioning of sophisticated corporate capital.
The key takeaway is the rotation. The smart money is actively moving out of the proxies that provided high premiums but no yield, like MicroStrategy, and rotating into assets that generate active yield, be it staked ETH or RWA products like YLES. And while that fundamental maturation is positive, caution is definitely warranted for leveraged positions until this acute regulatory and geopolitical fog, especially around that essential mining hardware supply, clears up.
So considering the DHS probe into Bitmain's physical infrastructure and the Cardano founder involving the FBI to police his code, we are left with a fundamental question for you to mull over as you digest this briefing. What happens when the idealized world of decentralized code meets the unavoidable reality of physical national security and law enforcement? What is the true long-term cost, measured in centralization or compliance, of securing a globally distributed physical infrastructure?